When you check the treasury markets, you witness something that will be studied for decades, the financial equivalent of a trusted ally turning away. You watched a partner unload American debt on a scale that redefines liquidity event. The actor isn't China or Russia, it is Japan. The nation America helped rebuild after World War II, defended by its military, considered its most reliable Asian ally. They have begun the largest coordinated liquidation of American debt in modern history. Mainstream media calls it a currency stabilization measure. That is a sanitized lie. This is a desperate survival action. This is an emergency liquidation. This marks the transformation of the treasury market from a bedrock of stability into a theater of quiet panic. Let me walk you through what happened. Recently, the Bank of Japan issued a statement, a PDF posted quietly on its website. The language was sterile, evaluating measures to defend the yen. Within 70 minutes, overnight Treasury futures in Chicago began to drop not gradually, but sharply. Algorithms detected the liquidity shift before any human analyst on television had read the statement. By midnight Eastern Time, the 10-year Treasury yield had jumped 38 basis points. That is not normal volatility. That is a gamma event. It is what happens when a cornerstone holder stops buying and starts selling. Here is what they are not telling you. Japan holds over $1.1 trillion in U.S. Treasury bonds. They are the largest foreign holder of American debt. China has been slowly reducing its holdings, but Japan kept buying, kept recycling trade surpluses into treasuries. That was the post-war bargain. We provide security, they fund our deficit. That bargain has just been ripped up. First, understand the mathematics of the crisis. Japan's currency, the yen, has been collapsing. In recent years, $1 has gone from buying 103 yen to buying 163 yen, a devastating devaluation. Japan imports everything, oil, food, raw materials, all priced in dollars. When the yen falls, their import costs explode, inflation spikes, and the population panics. The Bank of Japan has two choices: raise interest rates to defend the yen or sell their dollar reserves to buy yen. Raising rates is impossible. Japan's debt to GDP ratio is 264%, the highest in the developed world. Higher rates would trigger a sovereign debt crisis, so they must sell dollars. They must dump treasury bonds, and that is precisely what is happening. The mechanics are where this gets dangerous. Japan does not simply hold bonds in a vault. They use them as collateral in the global repo market, the plumbing of the financial system. When they sell, they are pulling collateral out of that plumbing. Algorithms detect the withdrawal and front-run the next seller. A gamma flip occurs. Volatility shocks the system. Suddenly, the treasury market is pricing not an orderly auction, but an emergency fire sale. The proof is in the data. A recent 10-year treasury auction saw weak demand. The bid-to-cover ratio, a measure of auction health, came in low. Participation from foreign central banks, the so-called indirect bidders, fell to its weakest level in years. Translation: foreign buyers are backing away. The primary dealers, the big banks forced to buy the leftovers, got stuck with inventory they do not want. They immediately hedge by shorting treasury futures, creating a vicious, self-feeding loop of selling pressure. Contrast this with China. China reduced its holdings slowly, strategically, over years, rotating into gold and commodities. Japan does not have that luxury. This is not a strategic rotation. This is a financial emergency conducted in compressed time because their currency is in free fall. Now consider the terrifying implication. If Japan sells, someone must buy. The Federal Reserve is not buying. They are reducing their balance sheet. The European Central Bank is not buying. They have their own crises. China is selling. So, who is left? Domestic buyers, U.S. pension funds, insurance companies, retail investors. They will only buy if the yield is high enough to compensate for the risk. That means yields must go much higher. This is where my own analysis, my reading of the situation, leads me to a stark conclusion. We are witnessing the early innings of a collateral crisis. History offers clear parallels. The collapse of the Bretton Woods system in 1971, when France drained U.S. gold. The 1985 Plaza Accord that sparked Japan's lost decades. The 2008 repo market freeze that toppled Lehman Brothers. Each crisis involved a collateral or liquidity problem. We are watching the same script unfold, with U.S. Treasuries as the failing collateral. If Japan's forced selling pushes the 10-year yield sustainably above 5%, which is entirely possible, the Federal Reserve faces a catastrophic choice: let yields rise and risk a deflationary credit collapse, or intervene by restarting quantitative easing, QE, admitting inflation is not controlled and debasing the currency. Either path destroys confidence. The first path crashes the economy. The second path destroys the dollar. And here is the critical, contagious element. Japan is an ally. When a rival sells, it can be framed as hostility. When an ally sells out of pure desperation, it signals that the treasury market itself is no longer a safe haven. It tells every other nation holding dollars, South Korea, Taiwan, the United Kingdom, to start planning their own exit. When everyone thinks about the exit at once, you get a stampede. You get a liquidity cascade. You get a broken market. The scale is staggering. If Japan sells just 10% of its holdings, $110 billion, that is a massive shock to absorb if compressed into days, not weeks. It could trigger algorithmic feedback loops, forcing other holders to sell and pushing potential selling pressure toward $500 billion. The market cannot absorb that without breaking. This brings me to a point where I must ask for your engagement. The narrative that everything is fine is a dangerous fantasy. If you are seeing bond yields spike in your own accounts, if the official story feels disconnected from the data, you are not alone. We need to see the reality together, and to stay ahead of this, you need to be where this analysis continues. Make sure you are subscribed. When this accelerates, you will not get the truth from the nightly news. You will get it from those watching the raw data. Do not wait until the doors are closing. Let me walk you through the probable timeline based on the patterns we can observe. Phase 1. Now. Quiet, persistent selling. Japan reduces holdings by $50 to $100 billion over a quarter. Yields drift higher. The media ignores it or calls it normal volatility. Phase 2. Acceleration. Selling intensifies to $200 billion in a month. Yields spike. Algorithmic volatility explodes. The VIX index jumps. Media coverage frames it as mysterious bond market turmoil. Phase 3. Contagion. Other foreign holders join the exit. South Korea, Taiwan. Others begin reducing positions. Coordinated selling reaches $500 billion. The treasury market structure breaks. 10-year yields hit 5.5%. Mortgage rates approach 8%. Credit freezes. Phase 4. The endgame. The Federal Reserve is forced to intervene, restarting QE as the buyer of last resort. This is the explicit admission that the treasury market cannot function without perpetual monetary support. It is the moment the dollar's exorbitant privilege ends, not by decree, but by market action. This is the Weimar playbook. This is how empires debase their currencies to fund deficits until confidence evaporates and people flee into real assets. Now observe what the smart money is doing, not saying. Hedge funds are shorting long-dated treasuries. Sovereign wealth funds and central banks are buying gold at a record pace, over 1,000 metric tons per year recently. They are not buying shiny metal. They are buying an asset with no counterparty risk, diversifying away from the dollar. And this leads me to another layer of my speculation, one that ties this treasury crisis directly to your personal portfolio. In this environment of currency debasement and lost confidence, the most undervalued real asset is not gold, but silver. The gold-to-silver ratio is historically high. Silver has a dual role, a monetary metal and an industrial necessity for solar panels, electric vehicles, and advanced weaponry. The physical supply deficit is enormous and sustained. The paper market for silver is a leveraged fantasy, with claims dwarfing deliverable metal. When the rush from paper to physical assets truly begins, silver will not just rise. It will recalibrate to a reality that has been suppressed for years. The disconnect is already here. Try to buy a physical silver coin today. The price you pay will be $4 to $6 over the spot price you see on a screen. That premium is the canary in the coal mine, the real price of tangible scarcity versus paper abstraction. Japan's households understand this. They are among the world's largest holders of physical silver. They are not trading paper contracts. They are storing metal. They see what is coming. The mainstream media will not connect these dots until it is too late for you to act. They will call it a dislocation after the fact. They will blame speculators. They will not tell you that the system was built on unsustainable leverage and that the foundation is now cracking. To tie this together, Japan's monetary crisis is forcing the liquidation of U.S. debt. That selling will push yields higher, forcing the Fed into a catastrophic policy choice. That choice will lead to further dollar debasement and a global loss of confidence. That loss of confidence will trigger a stampede into hard assets. We are not at the end of this chain. We are at the very beginning. This is not fear-mongering. This is the observable collision of mathematics, market structure, and geopolitical reality. Empires do not fall with a bang. They fade through the gradual, then sudden, loss of trust in their promises. The Japanese liquidation is a deafening signal that this loss of trust is now underway. Your only defense is to hold what they cannot print, default on, or devalue with a keystroke. Position yourself in reality, not in promises. The window to do so calmly, while choice still exists, is narrowing by the day. When the stampede begins, there will be no time for deliberation, only regret. The data is clear. The only question left is what you will do with it.